Welcome back. Chapter 2 begins our real foray into finance. I mean, real finance with real calculations in them. Finance is about numbers, lots of numbers. Still, it'll be a very gentle introduction. The concepts we cover underlie everything in finance. They are so basic and universal that chances are that you probably have already used them all. You may even know them so well that this chapter may feel like a waste of time. However, please indulge me. If it feels a little slow at the outset, I want to make sure we build our house on solid foundations. I want to make sure that we're all on the same page. I promise that it will get a lot more interesting, but also a lot more difficult as the course progresses. The kind of questions we want to answer in this chapter are: when can you add or average rates of return and interest rates? When not? If a bank posts an 8% interest rate and you deposit $100, will you have $108 at the end of the year? What projects should we undertake and what projects should we pass up on? And a little bit more applied, are fast-growing companies better investments than slow-growing companies? Now, a lot of these questions are a lot easier to answer if we work in what finance people call a perfect capital market. I'll explain it in detail in a moment. So for the next few chapters, we will pretend that we live in just such a perfect capital market before we move on to more difficult and realistic scenarios. Let's start. The first thing we've got to cover is what a perfect capital market is, and I'm going to use also something similar for an incomplete capital market, which is of course the opposite of a perfect capital market, and I'm going to use the abbreviations PCM and ICM for those two. Okay, a perfect capital market, PCM, must satisfy four assumptions. The first is no differences in opinion or in the information that we have. So if we look at something random, an outcome, who will be elected in the next general election, we always agree on this. So we can have uncertainty. We may not know what comes out, but we don't have a disagreement on the information that's out there. We don't have differences in opinion. The second is no taxes, which is a little bit overkill, but there are cases where this is important. So whenever we want to buy or sell something, there are no taxes that are involved here. The third is no transaction costs. So if I want to sell some stocks, bonds, my car, my house, anything to you, it doesn't take a broker who charges a lot of money for this. And the fourth one is no big sellers or big buyers. That is, for any good that we may want to buy or sell, there is 100 buyers and 100 sellers that are reasonably smart and of the same type that we are. So, no differences in opinion. Uncertainty is okay, but everyone must agree exactly about the uncertainty. So, roulette uncertainty is okay. Not okay is, I know that my car sucks and I'm trying to sell it to you. We must not have different information or opinions. Otherwise, I don't even know what to talk to you about, because whose opinion should we go by? Yours or mine? Assumption number 2. The government is still in the picture. It still enforces property rights. So it still allows us to assign property rights, to contract, but it does not tax or interfere in the affairs of consenting adults. It's not okay to have a 40% tax on interest income. It's also not okay to have rent control or anti-gouging laws. It must really be allowed for me and you to agree with one another what we want to sell things for or what we want to contract about. No transaction costs, neither direct nor indirect. So a direct one is something like a real estate commission that you have to pay to a broker when you're selling your house. But there's more than that. It must be almost instant that when you want to sell something, you can sell it. You don't have to sit around on the good, because that is an indirect transaction cost and it makes it costly for you to wait. So you want to list your house, it may take months before it sells. It's not useful during that time. All of this is out in a perfect capital market. And No big sellers, no big buyers, as I just told you. There are just many, many investors that are all competing. So we have something like a reasonable market price that we understand comes from many buyers and many sellers. Why are we assuming a perfect capital market? Well, some financial markets seem very much like a perfect capital market. Others, not so much. We'll have to be able to cover both. The analysis that we're going to do is a lot easier in a perfect capital market. So we want to start with that one. Once you understand this, you can start thinking about how to do it in an incomplete capital market. Let me explain this with an analogy. Say I wanted to teach you ballistics. I would have to explain to you all kinds of different things like gravity and air resistance and maybe relativity. It's just very difficult to understand all of them at the same time. So it's much easier if we do gravity first. So I can start explaining you the world if there was only gravity and no air resistance and no relativity. My formula, whatever I come up with, should also work in some situations that are very close to this scenario. For example, on the moon or in space, there is no air resistance. So whatever formulas I'm coming up with, I can test right there. Now, later on, when I want to figure out what to do on Earth, I need this variable for air drag. That's going to be needed to make my formula work better. It would still work with air drag, but just not as good. So I know that I can first analyze the problems in the simple way. I know that in an extreme case, that is like on the moon, it has to collapse to the simple case, but it's not the perfect formula on Earth. And when I want to make it work better on Earth, I have to add all the other things to it. This is pretty much what we're going to do with perfect capital markets. If a formula approach doesn't work in a perfect capital markets, then it will surely fail in the incomplete capital markets like Earth 2. I've got to get the gravity component right. The reverse is not true. A formula may work in a perfect capital market, like on the moon, but still fail on Earth, as it will, because there is this air resistance. As markets get closer and closer to perfection, whatever incomplete capital markets formula you may want to use must converge to the perfect capital markets formula. So think about the perfect capital markets formula as a special case of the real world, as a special case of the incomplete capital markets formula, that it's simpler and easier. The incomplete capital markets is the general case. It's much more complex and difficult. So for this reason, what we're going to do is we're going to push it to the second half of this class. Chapters 12 and 13 will explain why. The perfect capital markets buys for us something really simple. It buys the fact that if I want to borrow money from you or if I want to lend money to you, the rates are the same. So there is no wedge between that. And that has a lot of consequences. So let me tell you the worst one. If we don't have a perfect capital market, if we have an incomplete capital markets, then the value or price of any object will depend on the owner. How much patience the owner has, how much wealth the owner has, or the purchaser for that matter, how much patience the purchaser has, how much wealth the purchaser has. We don't have a single objective asset price anymore. So if at this point you ask me, can you please value for me this painting? Well, I would have to ask, who are you and who am I? And who is possibly else out there? Oh my God, yikes, this is very, very difficult. So let's wait until chapters 12 and chapters 13. Now for something completely different, for those of you who have seen Monty Python. Unless otherwise specified as real, all quantities in this class are assumed to be nominal. The interest rate is 15%, always means 15% nominal. That's not just for this class, that's standard convention. I'll briefly discuss inflation in chapter 4. Presumably, these nominal rates are set partly by the expectation of future inflation, and there is some ways to contract around it, but trust me, we'll just do nominal. Now, in chapter 2, our first chapter, we assume perfect certainty. That is, you and I both know what the rate of return is on every investment project. We also assume that the interest rates over any time horizon, over any term, must be the same. That makes life even easier. That means you don't even need to know statistics. There is no risk, so you don't need to worry about risk preferences either. So we start with a world that is truly simple and easy, and then generalize up. If this perfect capital markets without uncertainty seems too easy, it's because it is. Have some patience, Kemosabe. Yes, it's a little boring, but it's so easy to understand that it's like comfort food. It's really useful to understand this setup perfectly, because when we try to understand the real world, the real messy world, we have something to fall back on. Moreover, there are actually a few real-world capital markets that are very close to a perfect capital market with certainty. And they're not obscure at all. In fact, they're some of the biggest financial markets in the world. Oh, shoot. One more. Before we can really start, we have to have one more prerequisite that we have to take care of. That's notation. We can't write out every name, or we'll never be able to fit formulas onto the same line. We need abbreviations that are easy to remember. Though it'll always be a problem for boomers like me with memory impairment problems to remember anything. I also don't like that notation can be quite nitpicky, but it's important for me to be nitpicky so that we are on the same page. You have to be able to understand without confusion and ambiguity what I'm trying to teach you, rather than to just have to guess it. So let's get it over with. Most of our notation is very standard and also widely used, not just in classes. You will encounter it in the real world too. And again, and again, and again. Time conventions. Typically, the time convention is 0 stands for today, right now. 1 means next period. That could be a day, a year, whatever units we are working in. Small letter t means some time period in the future. And when we use capital letter T, it usually means the final time period. Note that here we actually have sensible notation, unlike the Americans that call the ground floor level 1. In Europe, we call it level 0, and level 1 is up. A stock quantity. What's a stock quantity? A stock quantity is something that is a snapshot at a moment in time. For example, firm assets on December 31st, 2024. That is a stock quantity. A house price on July 1, 2022. That is a stock quantity. However many credit cards you have in your wallet at this moment in time, that's a stock quantity. When you have a stock quantity, you only need one time subscript. A flow is something that happens over a period of time. Usually it accumulates over a period of time. So for example, earnings, Q4 earnings from October 2024 to December 2024 requires one time index for October, one for December. So it requires 2 indexes, or a rate of return from July 23 to October 23. It's over a time frame. Or the sales from 1920 to 2025. All flows need 2 time subscripts, one for the start and one for the end. Sometimes the distinction is not exactly clear. So, dividend payments in Q4. Were they being paid in a particular instance on December 5th at this time? Or are these the dividends that are applicable to the entire quarter, which started in October 1st and December 31st? Here is another set of notations that are very important. C is what we're going to use for cash. That's a stock amount. P is what we're going to use for price. Again, a stock amount, whatever it's worth at that moment in time. CF is what we're going to use for cash flow. Usually that's a flow, as the name says, cash flow. So it means all the money that comes in over a period of time. D is an abbreviation for dividends. Usually that's a flow. E, earnings. Earnings is something that you usually earn over the whole quarter, or over the whole year. So it's usually a flow variable. For the rate of return, which is always a flow variable, that means it always has a start and an end, there are different abbreviations. So people can use small r, capital R, or ROR. All of them are in wide use. So here are uses, for example. C sub t, the cash amount at time t. P sub t, the price at time t. D, t minus 1 to t, the flow of dividends from t minus 1 to t. Now, sometimes you see things like earnings or dividends with just one subscript, and that's an abbreviation for the case where it's t minus 1 just before the t. So it's super common and somewhat confusing as well. So when I say D5, I don't mean D from 0 to 5, I mean D from 4 to 5. And then I can also write D15 to 20. So that's, of course, the flow of dividends from time 15 to time 20. Return versus net return versus rate of return. If you buy at $10 and sell at $15, the return that you get is $15. That's a stock quantity. The net return that you get is net of how much you paid for it. In this example, it's $5. That's a flow quantity. The rate of return, P1 minus P0 divided by P0, is 50%, always a flow variable. But what if somebody says, your return is 50%? Makes no sense. For sure, it's not 0.5. If nothing else, it's got to have a dollar amount to it. Well, what they really mean is that the rate of return is 50%, and they are just loose. So they assume that you will know that they mean the rate of return is 50%. So R, R1, R1520, R5, all of these are in very common use. Also, if an investment is a loan, the rate of return is usually called an interest rate. They're really the same thing, though. And we've got a little bit of a language ambiguity here. So let's presume we're going from 5% interest to 10% interest. Is that 5% more interest or 100% more interest than 5%? We want to disambiguate this because this kind of scenario happens very often where you want to say, well, the interest rate has gone up by 10, 20%. So what was invented for this purpose is points and basis points. And what that means is 1 full point always means 1%, like from 5 to 6%. That is not 20%, that's 1 full point. 1 basis point means 0.01%. So 1 basis point higher than 5% is 5.01%. The difference between 5% and 10% is 5 points or 500 basis points. That's it for this video. We've covered our basic perfect capital market working scenario and the most important notation that we'll use throughout our course. We've just dipped a first toe into the sea. In the next video, we'll start dipping our other toe into some real finance and real numbers. We'll go over rates of returns, compounding, interest rates and interest quotes, net present value, basic capital budgeting. Lots to cover. See you soon. Bis bald.
My problem in life was that banks and women did not treat me alike.
Oh, what do you mean?
I never got the 0 interest rate treatment from my bank.
Your luck, you're getting it from me.
Ouch, that hurts.